I'm going to look into why wages aren't rising and why this is an issue given that inflation is soaring. I'll explore two potential explanations. Firstly, decentralized labour markets and slow productivity growth. And don't stress, you know what these two things mean by the end of the video. Thanks Manny, I'll take it from there. If you haven't already, what are you waiting for? Hit that subscribe button and let's get into it. Alright, so since the 70s, wage growth has been pretty slow. Since 1996, GDP per work hour grew by 30% in 16 advanced countries by the likes of the UK, USA. However, real hourly wages, even after considering non-monetary benefits, grew by only 19%.
What about down under?
The annual rate of wage growth in Australia over the past year was 2.6%, less than half that of the inflation rate, which is at 6.1% over the past year.
Who cares about down under? What about up over?
It's a similar story in the US, with wage growth at 5%, still lagging behind inflation, which is at 8%. So what's the issue?
Maybe stop being a crybaby?
With inflation double that of wage growth, purchasing power is falling. For example, Australia is seeing the strongest wage growth since 2014. However, real wages have never dropped so much over the past 2 decades.
I don't speak economics. Can you please say that in English?
Okay, let's say you made 100,000 in 2012 and now you make 130,000.
Yeah, go on.
Well, guess what? You're still at square one. The amount of stuff you can buy with your wage today is the same as 10 years ago.
That really grinds my gears. How is that even possible?
Inflation. What's strange about this low wage growth is that at the moment we've got tight labour markets.
Oh, so you mean supply and demand? So high demand, low supply means higher prices?
Yeah, well done, champ. So since labour shortages are at record levels, with a basic understanding of economics, you'd expect wages to be rising as well, as firms outbid one another to get access to that labour. But we aren't really seeing this. One explanation for this is the way in which pay rises are determined these days. In the 70s, across advanced countries, this process was much more centralised. This was basically where wages and the conditions of workers were determined by the government. Now, this did work to the extent that real wages were maintained. But now we have a more decentralised labour market. This means that apart from setting the minimum wage, the government gets out of the way and the rest of the negotiation occurs between the employee and the company. So now if inflation is at 6%, there's nothing stopping companies from continuing to give pay rises of 3%, well below inflation, essentially leaving workers shortchanged.
Yep, this is Crime Stoppers. How can I help you?
Hi, I'd like to report a theft.
Okay, what was stolen?
My purchasing power.
Now another explanation is slow productivity growth. Now this is about how much output we are producing given the inputs of labour, capital and technology. Now over the last 80 years, the US averaged 2.1%, but over the last decade, it's only been hitting 1.3s to 1.4s annually. And now for the last 2 quarters, productivity growth has actually been in the negative region. Other advanced countries are in dire straits. For example, the United Kingdom saw productivity growth averaging about 1% over the past decade. Now this is a problem, isn't it? Essentially without this, wage growth is not possible. Thanks for watching, y'all. Now my next video will be about the relationship between unemployment and inflation.
Want to make a difference in the world but don't know how? Well, you can subscribe to this channel and hit the like button.
Thank you.